Look at your screen. Look at your brokerage account. $1 trillion. Gone. Evaporated from the United States stock market in a single brutal trading session. If you open the news right now, the talking heads are in full panic mode. They are screaming about the Middle East. They are pointing at the news ticker. They are telling you that geopolitical tensions are the only reason your portfolio is bleeding. But they are looking at the exact wrong lever. Retail capital is completely blind right now. They are distracted by the loud geopolitical noise on Twitter. But underneath the surface, a structural catastrophic liquidity drain is happening in real time. And the real signal today wasn't a missile. It wasn't a peace treaty. It was a devastating collapse in mega-cap tech liquidity. Let's talk about the real elephant in the room. Meta just evaporated $130 billion in market cap. It closed down nearly 8%. That is not just a bad PR day. That is not a minor earnings miss. That is generational wealth destruction. It was triggered by a landmark liability ruling. A jury found Meta and Google liable for a 20-year-old woman's mental health struggles. They linked her severe addiction directly to their social media algorithms. They ordered the companies to pay massive damages. And yes, Meta and Google are going to appeal this. But the algorithms don't care about the appeal. The algorithms only care about the floodgate of litigation that just blew wide open. Wall Street can price in a bad quarter. They can model an economic slowdown, but they cannot mathematically model an open floodgate of endless, unquantifiable legal liabilities. This ruling permanently reprices the risk for the exact mega-cap stocks that are single-handedly holding up the S&P 500. Look at Meta's daily chart. It is a bloodbath. The multi-year trend broke. It snapped violently right at the $580 starting line. We watched a 40-point intraday plunge that established a vicious new downward momentum. When a trend that massive breaks, you don't just magically bounce back. The downside targets are now sitting dangerously low. We are looking all the way down to the mid-April 2025 support zone, right around 490 to 500. That 500 level is going to act like a magnet if this selling pressure continues. And if you think this is just a Mark Zuckerberg problem, you are not paying attention. The rot is actively spreading. Alphabet is dropping in pure sympathy. It fell right under the critical $278.50 level. The tech shield that protected your 401k for the last 3 years is dissolving. And the broader market is literally tearing itself apart in response. Look at the last 3 months. 28 times, we have had 28 separate trading days where the S&P 500 opened, picked a direction, and then completely reversed course. That is basically one entire calendar month of pure, unadulterated schizophrenia out of 3. That is not a normal functioning market. That is a direct, terrifying parallel to the volatility we saw during the 2008 financial crisis. For reference, in 2008, we had 35 of these violent reversal days, and we are already at 28. The foundation is cracking. The plumbing is broken. So let's look under the hood of the S&P 500 because SPY is sitting exactly 7.62%. Away from its all-time highs, we are kissing official correction territory. But it's not just the percentage drop that matters. It is the structural floors that are giving way. We had a massive safety net, a historically strong support zone, right around 650 to 653. Buyers always stepped in there. Today, that support completely failed. And when the floor drops out, it instantly becomes a ceiling. Old support becomes concrete resistance. We saw SPY try to bounce today. It pushed up, hit 655, and was immediately and violently rejected by the algorithms. Now, everyone is staring down the barrel of the brand new 2026 low, 642. If you are buying blindly at these levels, you are playing chicken with a freight train. And that brings us to the ultimate nightmare scenario. Global capital is trapped in a brutal vice grip. Inside the market, tech is fracturing. Outside the market, a physical supply shock is threatening to choke the global economy to death. Let's cut through the political theater. Investors got a tiny bit of relief in after-hours trading because Donald Trump posted on Truth Social. He said he is pausing the energy plant destruction in Iran for 10 days. He said Iran is begging to make a deal and that they are beat to shit. But the reality on the ground is completely different. Iran immediately responded to Trump's 15-point peace proposal. They called it pure deception. They called it a pathetic ploy just to lower oil prices and buy time for an American ground invasion. And then Iran doubled down. They demanded international recognition of their absolute authority in the Strait of Hormuz. They basically looked at the West and said, "We own the choke point." And they backed it up by announcing they have more than 1 million troops standing ready for a ground invasion. Because of this, the Pentagon is actively preparing military options for a final blow. We are talking about boots on the ground. We are talking about massive bombing campaigns. We are talking about blocking or seizing ships that export oil on the eastern side of the Strait of Hormuz. And when a military threat of this magnitude hits a market that is already structurally weak, the downside velocity goes exponential. The White House is not playing games right now. The Trump administration is actively running contingency plans for what happens if oil surges to an unimaginable $200 a barrel. Listen to me very carefully. You cannot fix $200 oil with a software update. You cannot margin call a physical barrel of crude. Breaks the consumer. It completely breaks the global supply chain. We are already seeing the physical breaking points. Look at Australia. Over 500 gas stations have entirely run out of fuel. 187 of them are completely drained of diesel. Nothing empty. This is exactly why the OECD just released a forecast, predicting that this war could cause inflation to skyrocket to 4.2%. That would be the highest among all G7 nations. Capital is terrified, and the institutions are quietly heading for the exits. But hold on. Before you go liquidating your entire portfolio, before you run to the basement and start hoarding canned beans, we need to talk about how this market actually moves. Retail investors always make one fatal mistake during a panic. They assume the market is just going to crash in a straight line forever. It doesn't. Volatility is a massive double-edged sword. Remember those 28 reversal days we just talked about? That means violent, face-ripping, short-covering rallies are a mathematical certainty. The market is specifically designed to trap the late shorts who panic sell at the absolute bottom. To kill this short-term bearish trend, SPY has to firmly break and hold above that 655 level. Until it does, we remain defensive. But we are already seeing pockets of min reversion algorithms stepping in to catch the knives. Look at Adobe today. The stock gapped down hard in pre-market. Everyone thought software was dead, but it bounced. It managed to hold a critical support zone right around 237.502, 238. That proves the intraday min reversion bots are still plugged in. They are still actively hunting for extreme discounts. If Adobe can break above its high today, it has a massive gap to fill all the way up to 246. This means you cannot just blindly short the whole. You need extreme precision. You need to respect the levels. If a stock like Western Digital breaks under 272, the floor falls out. If Zoom Communications breaks above 81.10, the momentum continues. You have to trade the actual tape, not your emotions. The megacap trends are officially broken. Macro volatility is exploding in the Middle East. You must adopt a strictly defensive capital strategy. Capital preservation is the only metric that matters right now. The historical baseline is absolutely verifying our thesis. In 2008, we had 35 of those violent reversal days. In 2026, we are already sitting at 28. We are walking right on the edge of the cliff. If these current structural floors give way, the ultimate downside target for SPY is a brutal test of the Liberation Day peak, sitting all the way down at 613 to 615. That is the final safety net. The algorithms are emotionless. You need to be too. Stay disciplined, and I will see you in the next one.